Hey guys, this is a market update. In this video, I'm going to go over the absolutely massive amount of signal that we got over the last few weeks from some Scott Bessent interviews and some other information that came out. We know exactly what government policy is going to be, and we know exactly how that is going to affect Bitcoin. This bull market carries on, and Bitcoin is something you have to have in your portfolio. I don't recommend day trading it. I recommend holding as much as you can for as long as you can. And you can trade around the edges, of course, and I do as well. But you have to have this fundamental position in Bitcoin, because what we've been told is absolutely disastrous for currency holders and bond holders. You are going to get destroyed. But Bitcoin is pricing this in, and you can see it in the charts as well. So before we get into the video, the 20% discount for the crypto course runs out next week. If you type BTC at checkout, you get 20% off this coupon code here. You get 300 videos. I update it for free forever for existing users. You can check it via the link in the description below. Look, we're at 108,000. We're breaking out again in dollar terms, but in bond terms, we are absolutely screeching into new all-time highs. I'll show you that at the end of the video. Why is Bitcoin going up? It's because the currency is debasing. Not only that, but we've been told exactly what the policy is, which is we are going to inflate the economy. We're going to print currency units in any way that we can. We're going to stimulate prices higher. Inflation, same old, right? This is why we're in Bitcoin. None of these stories made massive headline news. They never do. But these are the most important things to focus on. And so what we've had over the last week or so is a complete capitulation of all of the stories we've been told going into the Trump election, that we're going to cut spending, we're going to sort everything out, don't worry, the adults are in charge. And I said before the election, it doesn't matter who gets in, spending continues. Now, we had maybe 4 or 5 months of pretending like they could sort things out, and they tried to ruffle some feathers, and the pushback was insane, and Elon Musk has basically given up at this point, right? And so you cannot cut spending. The government doesn't want to cut spending, and the people don't want spending cut either. And so spending continues. And that means bond holders and cash holders are going to get destroyed. Absolutely. You can see it happening in Japan. Interest rates are going up. The bond prices are falling off a cliff. Bond prices going down. Pension funds holding those bonds are having to sell the bonds to meet current liabilities. That is a pensions crisis. It's a bond crisis. It happened in the UK a year or so ago, when the pension funds, the gilts were coming down in price as the interest rate goes up. And so your collateral, right, that you have to sell in order to pay your liabilities is going down. We all know about that when we sit through Bitcoin bear markets. That's pension funds. They got bailed out, right? That was swept under the carpet. This is a massive issue. Bonds are going down in price, and it's causing shockwaves because pensions are built on this collateral, and the collateral is falling away. That's the issue, right? So the cuts aren't going to happen. So let's focus on Doge first. I've come to the perhaps obvious conclusion that accelerating GDP growth is essential. This is Elon Musk. The profligate spending of government. He's saying, I tried to cut and I couldn't do it. Now, if Elon Musk can't do it, right, who donated billions to the campaign, who got the ear of Donald Trump, who said, actually got Doge through trying to cut, right, was given the power to do this, he failed, right? They tried to cut 2 trillion. It was only 150 billion. I think any penny cut from spending is a success, so I won't call it a failure. But Musk has given up. He said, look, we can't go like into the machine. It's not going to work, right? So Musk wants to grow GDP to figure that out. You can't sort out this problem by growing GDP. GDP growth and the production of goods and services is not the issue here. The issue is that the government has liabilities in currency that simply the currency doesn't exist to pay the liabilities. In order to pay the liabilities, you need to create the currency from somewhere. There's not enough currency to pay for the liabilities of the government, right? There's a shortfall. You need to create currency. You need to print it. You can't find it in the ground. You need to create it out of thin air, right? And you can't do that, right? Because as soon as you print the money, you lose confidence in the currency and the whole thing unravels. It's a confidence trick. It's a Ponzi scheme, isn't it? And so that's the issue. It's not GDP growth. It's not the amount of iPhones that we have that's the problem. It's the fact that there isn't enough currency to pay these liabilities. So number one, Doge has failed. They're not cutting that much. Spending continues. Now we come to the new spending bill, which as this was passing through some legislative details, you could see Bitcoin just starting to go up into new all-time highs. And that's because this spending bill enshrines very large fiscal deficits, right? So if you cut taxes, then the government creates potentially less income for itself. And if you have less income from the government but the same liabilities, that means they just have to create more debt to pay for the liabilities, right? And so maybe cutting taxes can actually incentivize some GDP creation and some credit creation from banks. Maybe the tariffs can actually bring some of that back. We don't know exactly where this is going to fall out, right? But we can be fairly sure that if it's around a 7% projected deficit to GDP, and the spending bill is estimated to increase the current deficit by 33%, then despite some growth to GDP from credit creation and bringing manufacturing back, we can maybe say that the deficit is going to continue at some rate. Maybe it's 5, maybe it's 4, maybe it's 8, we don't know. But there will be a deficit. If there's a deficit, that means that currencies are going to get debased, more credit creation, more debt creation flowing in, mispricing goods. Assets will price that in, like Bitcoin, housing, stocks. They'll price that in and go up in value when valued in the fiat currency. A deficit is like QE, in my opinion. You're forcing currency units into the system, right? Misallocating capital, assets, price that in, forcing fiscal stimulus into the economy. So that's inflationary. By the way, all of this is inflationary, right? And that's because they require inflation. That's the thing they need to debase their liabilities. They need currency and they need price inflation to debase their liabilities. It's no good talking about the free market and GDP growth and how many TVs or phones that are made. That's not solving the issue. The issue is you have liabilities, you need currency units, and you need price inflation to debase the liabilities. And so this policy is good for that, but not good for people, right, that hold bonds or cash. You're going to get wrecked. And everyone in the economy who's trying to make a living, trying to price their goods and their services in this currency, which is volatile, and it's falling, and it's inflating, it's going up and down, it creates a drag on the efficiency of the economy as well, right? But in any case, tax cuts, higher deficit, like QE, massively inflationary, which is good for risk assets, actually, until the central bank comes in again. But, you know, they're holding still. And if they try and absolutely smash the economy by raising interest rates, that's another story. But for right now, all of this is inflationary, and deficit spending is inflationary, and so you have to be out of the currency and in assets. The third leg of the stool, as Scott Bessent says, right, is growing GDP faster than the debt growth. This, unfortunately, is not solving the problem. And Scott Bessent knows this, right? But this is just what they all say. We need to grow GDP faster than the debt. We need to grow out of it, right? Bessent will grow GDP faster than the debt, and we stabilize debt to GDP, no problem. Here's the problem with that, is that if you have the same amount of currency units, let's call them 21 million currency units, and you have an amount of production in the economy, right? That production is priced in relation to these 21 million currency units. Now, in the next year, if you grow GDP, you can grow GDP by growing output, right? So let's say in the next year you double output and GDP goes up. It doesn't mean the price of everything goes up, though, does it? Because you've still got 21 million currency units. So now that doubled production has to be priced in the same amount of currency units, 21 million. And that means the unit price of production gets halved. Things go down in price as they become more abundant in relation to the currency, right? Scarce currency creates abundance. Abundant currency creates scarcity. When you have scarce currency, if you create more stuff, the unit price of those things goes down. But that doesn't help the government with their problem, which is they have fiat currency liabilities that they have to pay out. And it doesn't matter how much stuff you have in the economy. It matters how much currency there is. You don't want more stuff and the same amount of currency because the price level comes down. And that means you're taxing as a percentage based on the amount of goods and services transacted. Your tax rates could actually come down. The problem for the government isn't GDP and the amount of iPhones that are made. It is the amount of currency in existence. You can't grow GDP constantly if you have a set amount of currency units. You have to grow the currency units. It's the only solution to the problem that the government has, which is they can't pay their liabilities. So it's not about growing GDP, actually. And Elon Musk saying this as well, we must grow GDP. It's not about growing GDP. It's about growing the amount of currency and inflating GDP by inflating currency units, inflating the price level by inflating the amount of currency units, and debasing currency to make the price of everything higher, so you debase your liabilities. Growing GDP is complete nonsense. It doesn't solve the problem that the government has. We have way more stuff than we had in the past. Look at the amount of stuff, iPhones, computers, flat screen TVs, everything, all these widgets. But the problem is no one can afford a house because the government bought all the mortgage-backed securities and forced the price up to bail out property holders. The problem is the money, the problem is the currency and the debts and the liabilities, not the amount of stuff we have. So you can't grow GDP. It makes it worse. You have to print money. And that's why they want manufacturing back. That's why they want to deregulate banks, because they want a credit creation boom to increase inflation, not increase GDP. You increase GDP by inflating the currency. So, same amount of goods and services, right? So 1 year you create this much, the next year you create the same amount. Now, instead of having 21 million currency units, I just double the currency units. GDP goes up, everything doubles in price. Not because there's more stuff or less stuff, it's because the currency has been manipulated. That's the issue. It's not GDP growth, it's currency manipulation. They need to print money, they need commercial banks to print money, they would love the central bank to print money and lower interest rates and force prices higher that way. They need inflation. They don't need GDP growth. They need inflation. That's what they mean. I think this is like QE. They're trying to spur credit. They're trying to get local banks to create more credit, print more currency. That's what they need. And that's inflationary as well. You have to be out of bonds and currency when that's happening. They want a credit creation boom. They want to debase the currency. They want to inflate prices. And that means assets price that in like Bitcoin. But if you're in the bonds and if you're in the cash, you're getting absolutely destroyed. Sam has it here as well. Pass new laws and tweak regs to suppress long end yields. Boost nominal GDP via inflation and currency debasement and credit creation. Debase the currency, bondholders and cash savers lose in real terms. If you hold bonds or cash, ever, you're getting wrecked, especially now. Bitcoin, other assets that can price this in, that's the only place to be. If Elon's spending billions on the Trump campaign and getting Doge actually enacted, right, can't solve the problem, I don't think anyone can. I think Elon is realizing, despite the promises made, that the current incentive structures are entrenched and there will be no meaningful reduction in spending. Yes, sigh. Based on comments and actions from the administration, I believe that we'll see higher levels of inflation. They need inflation, not GDP growth. They need inflation. They need currency debasement to reduce the actual cost of their liabilities, and they need actual currency to actually pay for them in real time. This is Bitcoin against TLT, which is the long bond ETF. And this is it priced right here. So what you're seeing, not Bitcoin in dollars, but Bitcoin valued in bonds, which are currently going down in value. If you hold a bond, right, yeah, you're getting paid some interest. But if you need to sell that bond before its maturity, you have to go to the open market and get the market price. And the market price for bonds is collapsing as interest rates go higher. In Japan, the pension funds are finding this out. There's a huge collapse. They're having to sell them to meet their current liabilities. That creates more selling pressure. The only way out of that is for the government to step in, print currency, and buy the bonds. It's the only way. So if you're in bonds or currency, you're getting wrecked. Now, if you can time it, if you can time QE, right, so you know exactly when basically the bond market collapses, the government and the Feds, other central banks step in and said, yield curve control, we're printing money. Well, buy bonds then, because they're going to go up in price. But just buy Bitcoin over time is the positive way to play this. Bitcoin valued in bonds is going through the roof. Right? And that's because bonds are falling away. Bonds are risky because they are the debt of a completely insolvent financial system. Please don't hold them, okay, over the long term. Now, if you need, cash short term, going into T-bills or whatever, or your local, short-term debt, I understand it. But if you're a long-term investor and you're tucking some money away, like bonds are going to destroy your purchasing power. Absolutely wrecked. So you have to go into something else. So 20% discount for the crypto course runs out next week. If you want to trade on Bybit as well, trade Bitcoin and crypto here, 30,000 deposit bonus down in the description below. I'm James, this is MyGG. Cheers for watching, and I'll see you in the next one.